Welcome back to Finweek Money Matters. Now, executive remuneration is a hotly debated subject, and performance-linked share incentives have been proposed as a good way to align shareholders and staff goals. However, these incentives are often poorly constructed and misunderstood by investors. We take a look now at what works and what doesn't. Paul Hunter is senior consultant at Hay Group, and Craig Gradidge is director of investments at Gradidge-Mahura Investments. Both join me in studio now with my co-host. Thank you so much for making the time to come in again. Perhaps let's come to you, Craig. Are share incentives the answer to that alignment that seems to be missing between performance, retention, and shareholders?
Yeah, I think it's part of the answer. I don't think there's any one answer. I think Paul could probably answer that better than I can, but having been part of these schemes myself, if you're in a larger organization, you still have that feeling of hopelessness that you can't really impact the bottom line meaningfully. But certainly if you have a 3-year tie-in and the incentives are meaningful and well structured, it can have a meaningful impact.
Paul, do you think that they address the retention dilemma?
So when we look at designing incentive compensation schemes, you would normally look to ensure that there's alignment between shareholders and managers, that you provide enough leverage or upside to drive the type of performance that you're looking for, and that there's a strong retention component to the incentive scheme design. Now, shares were popular throughout the 90s because the thinking was, well, the best way to align your managers with your shareholders is to give them some equity.
Right.
But more recently, the market is moving away from that because first of all, at lower levels in the organization, there's no link between or line of sight between what I do and the share price at the end of the day, so it doesn't really drive behavior.
Right.
The other thing is that probably 75% of the movements in a company's share price are driven by extraneous factors outside of the company's individual performance. So you can end up rewarding people because the oil price, for example, moves by a huge amount or whatever, and you get into the realm of things like windfall gains, which are against the code of ethics as per King 3, for example. So shares are not necessarily always the best way to align the managers with the shareholders.
The trend you've noticed is that these schemes are becoming less popular and less common? Is that what you're noticing?
That's right. There is a trend in the market to move away from employee share option schemes to cash-based schemes, especially at the more sort of middle to lower levels within the organization. So we still see a role for them in rewarding senior management, but at lower levels there are probably better ways of rewarding people and retaining people these days and through ESOPs.
Let's look at the benefits to the company, and perhaps let me throw this to you again, Craig. From a cost and a tax perspective, are companies really benefiting from implementing these schemes?
Yeah, again, look, I mean, from where I sit, we generally deal with employees when they're making decisions in terms of exiting the schemes. So I think Paul would be better placed to
I'm
answer
going to
that
get
question.
you on one at some point.
So I understand, Maro, to from an employee's perspective, when they're making decisions around what to do with their thing. So I think
okay, we'll get to the conversation around the exit.
Yeah.
Let's throw the curveball.
I actually wanted to just chat to you very quickly about the employees wanting to exit.
Yeah.
Now, you are tied in obviously over a 3-year period or 5-year period.
Yeah.
And you feel like you have done all that there is that you can do to this company. It's time to move on. Do you have any leeway to say, actually, can I cash in my shares?
Yeah, so it depends how the ESOP is structured. So typically after a 3 or 5-year period, all or a portion of the shares would vest. So they would now become unrestricted, and you as the employee would have access, and you would have a couple of decisions that you can make, whether to transfer the shares to a share portfolio, whether to cash them in, if it's options, whether to take the cash upside. And as an employee, there are a whole host of factors that you need to consider in terms of making the best decision.
But you have no space to maneuver within that first 3 years.
So in the first 3 years, well, that's so they're structured in order to, if there's a retention aspect to, skills retention aspect to having that ESOP in the first place, then yeah, that's it. you have to wait until that vesting period arrives.
Sir, I know I'm
Yeah.
probably getting onto this. Is there research somewhere that says when you give employees these share incentive options, then is there a correlation between that benefit and their performance? Or are you simply keeping people because, or are people simply staying because they have a benefit at the end of 3 years?
So I think it depends on how the scheme is designed.
Right.
So a scheme that has sound governance should have performance hurdles or thresholds in place that determine eligibility for shares, the number of shares, the vesting, etc. In cases where employees just get a blanket grant of shares every year, there often isn't a link between performance and the shares given. And this is part of the problem because people get shares every year. They don't understand how their behavior drives the share price or creates shareholder value.
Right.
And it becomes almost like an entitlement over time. So people feel that they're entitled to these shares, and it actually ends up pervasively driving the wrong types of culture and the wrong types of behavior in organizations.
Let's go back to the question that Craig was dodging about the actual implications on a company in terms of a cost and tax perspective. Is it a benefit for companies to actually implement these schemes?
Okay, so one of the reasons why the schemes were popular in the 90s is that there was no impact on a company's income statement in terms of issuing shares or issuing share options. There was an economic cost in terms of the dilution of the shareholders' equity capital, but no actual reported cost. And financial economists for a long period of time have said, but there is actually a cost associated with issuing these shares, and that needs to be reported somewhere. And in terms of the accounting rules, I think it's AC 139 has now been introduced where companies do have to show the cost in their income statement associated with the shares and the share options. That cost is deductible from an accounting or a reported profits point of view, but it's not in fact tax deductible to the company itself. So there is actually no advantage now to the company in terms of issuing shares over simply paying cash bonuses.
Right.
And because there's no big perceived cost advantage, it's another reason why organizations are looking more seriously at whether to use a share incentive scheme or some other type of vehicle to try and drive and reward performance in the organization.
But it seems like people can just use accounting wizardry to sort of manipulate anything, and share incentive schemes are just one of those things that can be manipulated.
Right. Look, I think after your Enron debacles and the Sarbanes-Oxley Act, the accountants are tightening up on the reporting and trying to close some of these loopholes. And this was one of the obvious ones because you could give value away without reporting on that value that is being given away. But that loophole is in fact being closed. And that's one of the reasons why companies are moving away from share options, because they now do have to disclose the value that's being transferred from companies.
So they almost seem to have a bit of a tainted reputation, like they have a shadowy element to them. Is that
to some extent, people will say they encourage the wrong sorts of behavior. They encourage managers to take risks that they shouldn't because there's huge upside. So I guess a lot of the corporate governance issues that came out in the late 90s and early 2000s, a portion of that is associated with the incentive vehicles that drove that behavior in the first place. And that might be one of the reasons why there's a move away to a more simple or a more pure or a more honest way of rewarding people through cash type
I want to
incentives.
backtrack to an earlier comment that Paul made about it not, share schemes not being a very good vehicle for rewarding junior level staff. And I want to come to you, Craig, with this and say, how have companies balanced eligibility with available equity? And do you find that there might be trends within companies where share scheme options are available that lower management actually aspire towards that particular threshold?
Yeah, it's a difficult one because, these schemes are all structured very differently. I can talk from my experience. Very often there's an empowerment element to an ESOP, and you'd find that the senior black managers are getting more shares than your junior black managers, but are they more black than the junior guys? So is it about skills retention or is it about empowerment? And then whether this actually creates some kind of incentive or motivation. I haven't seen any studies to that
Do you
effect.
think perhaps, I mean, we talk about retention for the last few minutes. I want to look at attracting the right skills. Are you finding that these schemes are maybe used as a carrot now to attract black professionals in the empowerment game?
It can be, and again, it depends on the terms of the scheme and the, what sort of waiting periods and vesting periods would apply and things like that. But what we, from our experience, we just see that, if I'm working at company A and I'm part of the scheme, if I go for an interview, I simply include that value in my negotiations with company B. So it almost sidetrack or bypass that retention aspect.
Right.
And it generally tends to be more attractive with listed companies because it's easier to create an ESOP than with an unlisted company.
Are companies at will to just create an ESOP the way they want it created, or is the process inclusive with employees, with labor, with employee representatives to say this is actually a much better, a more logical solution at the end of the day that we've created for our employees?
So what we would typically see is there are a number of stakeholders involved in the design of any employee share option scheme. If it includes your bargaining unit members or your unionized labor, they would obviously be one of the stakeholders that would be involved. You would include your management team, and then from a governance point of view, you need your remuneration committee as well as your board, because you need to make sure that the appropriate bodies are presented with the information, the cost of the scheme, and sign off on that body. So the design of any incentive scheme or share incentive scheme is quite a consultative process. And that's, so typically an organization would work with an independent expert like a consultant, and then all of these internal bodies from a governance point of view would be part of the process of designing and approving the incentive scheme.
When is a good time, Paul, for a company, a listed company, let's say a newly listed company, we were just talking about listings earlier, when is a good time for them to begin to apply their minds to offering these schemes?
Well, they should do that right from the start. I mean, that's one of the things you want to have in place, because you want to attract talent and you want to drive that value creation. And often in the early days, you might, for example, have cash flow constraints, and you need to be quite creative with the way in which you retain and incentivize people. But that needs to be part of your value offering to your employees and the way of attracting and retaining key talent right from the beginning. That must be part of your initial strategy.
And Paul, as you've noted that share incentive schemes are sort of falling out of favour, are there any innovative sort of new ways of remunerating execs that are coming out of the woodwork now that you're noticing?
So as I think in terms of senior executives, shares will always be a part of that. In a listed company, it's a pure share scheme. In an unlisted company, it might be some sort of phantom share scheme. But at other levels, there are certainly more innovative ways of paying people. And what you try to do is, without actually giving them shares, you try to create the same sort of mindset and incentive with a cash-based scheme. So we typically tend to see a cash-based scheme, but a portion of it gets held back or banked. That might be matched by the company when it comes to payout to provide some extra upside. So you try and give that sort of long-term mindset without some of, if you like, we spoke about the evils of equity from a share option scheme being, and the complexity of that being brought into the design.
How much of a backlash are these getting? Are these options and creations and how much of a backlash are they getting? Because here's a company that is obviously operating in a very difficult environment. Therefore, share prices going down, revenues going down, but you want to retain the CEO, you want to retain this executive team.
Right.
Therefore, you keep on saying, guys, please stay. Here's more shares, here's more shares. And yet you have a lower staff base that is not getting anything, and they're getting told the same story, that we're operating in a difficult environment, we can't afford these inflation plus 3, 4, 5 salaries.
Right, yeah. So, I mean, there's a couple of points there. The first is the discrepancy between your executive pay and your more junior levels, and that's not really a function of how you pay them, but how much they end up with at the end of the day, and what is fair for that level of job. And that's something you would want to look at. I think the second point is just around the unpredictability of shares. So what we tend to see with share schemes is if the industry has a bumper year, for example, you're in the oil industry and the oil price goes through the roof and everyone is on shares, you find enormous wealth is created for a whole lot of employees. But in a different industry, you might have 10 companies that are on a similar scheme, and there's little growth, and the shares end up being worth very little, and it ends up not motivating anyone. So everyone is disgruntled. So you either have a bumper year and you have some windfall profits and everyone earns huge bonuses, which then get criticized because the bonuses are excessive,
Right.
or the share price doesn't move, everyone works, achieves operational objectives and doesn't get any reward at the end of the day. The share options are underwater, there's pressure to revalue the share options, and it just doesn't reward people appropriately.
We've got about 2 minutes left, and perhaps let's get a comment from Craig before we go. Do you find that unions are open to the idea of equity in companies? Is this a viable option for them as against fighting for disposable income at the end of the month?
Yeah, look, it's difficult to answer for the unions, but most of your big unions have investment arms. So they're not against the idea of equity as a means of value creation. I think often it's, depending on the constituency that they're serving, whether that constituency has that same long-term horizon, because if you're earning 3,000 Rand a month, your needs tend to be more immediate and short-term. And that is what you're looking at. And so yeah, I think it would again be situation based, but the concept of equity, I think, is not lost on the unions, not at all.
Here's one question I received from one reader. Now, I have stayed for the 5-year period that I've been closed in for this share option scheme. Now if I leave the company, can I transfer my share options into actual equity in that company even though I'm no longer part of it?
Well, it depends if that thing has vested. So if they now have unrestricted access to those shares, then they could simply take it and move it to a share portfolio. So move the scrip across from the trust or whatever the structure is into a personal share portfolio and keep those shares. Or depending if the rules say they have to sell out and take the cash value. So it would depend on how it's been structured, but they certainly have that option.